When we hit expiration on a credit spread, bull or bear, and both options are still out of the money, even if the buyback cost showed 5 cents when you were getting ready to the close, 10 minutes to the close, the listed price on the market was, say, 10 cents at midpoint for your short option and 5 cents for the long, liquidate it for a 5-cent debit. As long as it's out of the money, both options expire worthless. We keep the net credit. He's just making it difficult for people who want to close early if it's right near the strike price, for example, Chuck. Okay? Now, in general, as you know, of course, but in general, if the stock was trading right here, God, that's a terrible line. Let me redraw that there. But anyway, if the stock was trading right about here, even at, this is a 31 strike, remember, for the short put that we sold. So if the stock was even trading at 30.99, okay, you would likely expect at this point that you'd be assigned, or especially at 30.95. If it's below the short strike on the bull put credit, even 1 cent in the money, you would expect to be assigned at expiration. I'd be forced to buy 100 shares or X amount of shares of KHC at $31 per share. Then on Monday, I could decide if I want to sell to close it, if I want to convert it to a credit, I want to convert it to a married put, or perhaps a covered call position, or maybe a standard collar. Okay? So to promote liquidity, even if you're 1 cent in the money, you're likely to be assigned. And the buyback cost might only be 5 cents in that case too, Chuck, as you get close to the last minutes before expiration. My mouse, I think the battery on my mouse is going low, but either that or I'm just a bad drawer today. So in any case, Chuck, that's what we're talking about there. As long as it's out of the money, everything expires. Even if you still saw a premium 1 minute before the close, it looked like it would cost you 5 or 10 cents to buy to close the position in that case, okay? So as long as you're out of the money, you're going to expire worthless, and you're going to be all set as well. Okay, so that's related to that. Let me see if there's, I got 4 more questions that just popped up. Great question, Fernando. It's one I always like to address there. Okay, good. Chuck says thanks, and okay. So before we get to Fernando's question, I've got Maurice. And Maurice says, in a rollout, how can you find the acceptable offer that the rollout will be done? Well, Maurice, I don't know what strategy you're trading, and that's okay. But last week we talked about, or 2 weeks ago, I believe, we talked about using the portfolio tools for evaluating rollout positions. And in general, that's still what I'll use if I'm looking to manage or roll a covered call position. Here we go, BA covered calls. Let's see if any of these are still active. Good, they all are. All right, so this one here is coming up to expiration in 7 days. Remember, BA was up at, this was for Larry and for VOW when we did this presentation a couple weeks ago. They had deep in the money covered calls, and we had Terry with a good Boeing married put, Maurice. Okay. So on the Boeing position here, let's just take Larry's. He was 132, and the stock had gapped up above 200. With yesterday's pullback, it dropped down. Wow, it had gone all the way down to 170 at that point. Now it's back up another $19 today. Oof, jumping all over the place. Hopefully Larry and VOW got to roll it. Okay, so I want to roll this position, Maurice, whether it's a spread or whether it's this. But what I'm going to do here is I'm going to evaluate rollout opportunities, tracking it in the portfolio. We'll go to position actions and then position analysis. The position analysis screen will give you a breakdown of your current position. And yes, Larry's original position was about a 1 or 2% loss because he had been rolling it. We showed him how he could convert it to a 2% win during the webinar, even rolling up, but now the stock has pulled back. So I think we were looking at, honestly, the 190 strike, if I remember correctly, on Boeing to still say a little bit in the money. So we're still doing pretty good if he gets assigned at 190. In any case, so we see our current liquidation value, the profit or max value at expiration if we're assigned, and then down below we see potential rollout opportunities. Now, in general, yeah, I'm going to focus on the 187.5 call here, out 7 days or 14 days to change this subtly losing position, Maurice, into a winning position. So you see here my new percent if assigned, even with a buyback cost of $61 or so from what I originally sold at $11.44 because the stock is at $189 and we're still holding a $132 call. I'm going to have to roll for a debit in this case, but that's okay because if I get assigned at the higher strike price with a premium of $12.20, I'm going to add a cost basis of 37.36. That's the drawback of rolling for a debit. But I turn this 1.2% potential loss into a 2.8% gain if we're assigned at the same expiration 7 days from now at the 187.5 strike. So yes, we paid a debit of 37.36, but we increased the strike prices by about 65, okay, from 132 to 187. Now, that's the bid. But what I'm going to do here, because it's great to see things numerically, Maurice, but I want to see things a little bit more graphically. So I'm going to go here, and we see a little bit 1250, so that's probably the midpoint price. So on this view, the simulate trade, we get a side-by-side comparison. Our original position on the left in red, and then the new position, what it would look like on the right in blue. And we jump up our, with the midpoint prices for the buyback cost, of course, and for the new sell to open, that's what we would look for. We'd look to get that new price there of 1250, buyback at 58.60 at the midpoint of our original call, and then we'd have a potential higher return. So Maurice, what I would do here, now that we know, we're going to roll from the 132 that we have to the 187.50. Okay, and what I'd like to do here is I might go into the option chain for this expiration, and you see that the call's only good. So that 187.50, the bid is 202, the ask is 266. So I'm going to target somewhere around, oh, that's today. My apologies. There we go. The one highlighted in red, Maurice. That's the one that makes the most sense, doesn't it? And so there we see the bid is 1220 if we rolled up to it, but the ask is 1280. I'm going to put my order in, Maurice, at midpoint. Okay, I'm going to try to get 1240 for that call. Now, unfortunately, we have to go to the large chain to get to my 132 strike, and there we see that the 5620 is the bid, 61 is the ask. So again, I likely target the midpoint I saw in the rollout opportunities, which had it at the trade simulation, excuse me, at 58.60. Okay, so I'm going to try to target that buyback at midpoint, try to get the 1250 at midpoint. If it doesn't fill in the usual first 5 or 10 minutes, then I might increase my ask price, lower my bid price from the midpoint a little bit here. The bid price here, just to try to get filled at a reasonable net debit between the two. Okay, so when you saw on the rollout opportunities, you could see the total net debit. It was around 37 or so. And here at midpoint, we'd be at about 36.10. Okay, so I apologize, 46.10, not 36.10, 46.10. That 37 we saw in the rollout took into account the original $11 in premium, Maurice. So seeing here on this page, seeing my debit here to roll of 46.10, that's what I'd put into my broker if my broker allows me to put in a debit to roll. I'd start there. Again, doesn't get filled in 10 minutes. I might increase the debit to, let's say, 46.20. Doesn't matter which one the market maker gives me, 10 cents higher, 10 cents lower, for example, but I'm still getting a reasonable price. The last thing I want to do is get filled at the natural ask price at $61 and the natural bid price is $12.20. Okay, I want to avoid that maximum debit if at all possible, Maurice. But this gives me a good starting point. Debit to roll of 46.10, the difference between the two. Put that into my broker as the debit to roll. And if it doesn't trigger, then maybe I increase it a little bit up to 46.20, maybe 46.30 to see if it gets filled. Now, hopefully you're not paying that much money to roll your positions, Maurice, but again, this was an example that we had a couple of weeks ago in that case. Okay, actually, Octavia, you are going to be next, but I'm going to take Robert first. Robert says, can I ask a question? Yes, you can, and then I think he figured that out. Anytime during the webinar, Robert, ask any question you want. Robert says, do you normally try to get the midpoint of a credit spread or just the bid? Always the midpoint, Robert, for me personally. I don't know how long you've been on the session with us, Robert, but a little while ago, we were talking to Maurice about rolling a covered call and what prices should he use to try to, what is a good target for the prices he should use when looking to roll a covered call position. And in general, I will look directly at the midpoint when trying to roll the position. Okay? And if I don't get it in the first 10 minutes or so, maybe 5 minutes, then I'll adjust it. My roll, debit to roll, excuse me, Robert, I might adjust it up to try to get filled, but I'm not ever going to try to take the natural. What I prefer to use typically, and I've been doing this for a while, and it didn't actually thankfully get hurt on Thursday. One was really close, but it bounced back, so I'm all good now for expiring this week. And on Monday, I'll open more positions. But I tend to follow these criteria that we've put together called the weekly bull put credit spreads. And what we're seeing here is the midpoint pricing on these positions. A pretty wide bid. There's Belwig again. A pretty wide bid-ask spread here, 2 to 278 for a 14-day out trade. But what I would do is if I was going to enter this with my broker, let's see here, I would enter in this midpoint net credit of 52 cents on the position. I would do that. I'd maybe put this at 240 and this at maybe 188 or something along those lines. But I try to get that 52 cents as my debit, my credit, my limit credit, excuse me, Robert. That's what I'd enter. If it doesn't fill in the first 5 minutes or so, first couple of minutes, I'll go back in and edit, maybe drop it down to 50 cents, see if it gets filled. If it doesn't get filled there, I might go as low as, let's say, 48 cents or somewhere along those lines, but what I want to make sure I don't do is go in at the naturals. Okay, I don't want to sell this. Naturally, I can't. If I sold this for 2 and bought this for 225, I'm entering a bull put credit spread as a debit, and I have no chance to win, okay? But I would have in the back of my mind, I already know in the back of my mind what my minimum target return would be, Robert, so that would be my threshold. If he doesn't fill me where I want, and let's say 45 cents was my bottom threshold, he's not filling me at 46 cents, excuse me, then I'm done. I'll move on. I'm not going to get a price I don't want just because it was at the top of the list. If I can't get filled and the bid-ask spreads are too wide, I'll go to something better. So Beyond Meat here is pretty decent. 166 to 183. Okay, so we've got a nice 17-cent bid-ask spread. I'm positive I'd probably get 174, 173 on this bid at near midpoint. And over here, okay, that's, well, the first one looked great. Second one isn't so great, 70 cents again. But it'll calm down by Monday when things start trading. Long story short, Robert, I always try to get filled at midpoint pricing. I never enter at the bid, and I never look to buy at the ask, and I have my threshold in there. So if it's not getting filled for whatever reason, the market maker, the electronic market maker doesn't like me today, I will move on and pick one of the next spreads where I can get filled at my target price to stay with my trading plan for what I'm doing with the credit spreads. My trading plan is I like to look for an 85% probability or higher, and I like to target a return around 13, 14%. Average is usually around 14.9% over various trades. So if I'm doing something and the target that I'm going to get is less than 12% against the margin, I'll stop and move on to the next one and try to get filled at that price, okay? And Robert, you're welcome. Good, good. I'm glad it all made sense, okay? This is still on the credit spreads. So William says, different William, not Will S., this is William. And he says, on your bull put credit spreads, you said on your weekly bull put credit spread strategy. Doesn't matter if it's weekly or monthly or whatever. If a trade goes against you, what is your bailout strategy? Do you close the trade based on predetermined loss? And if so, what would that be? Or do you let it expire completely for max loss? Never let it expire completely for maximum loss. I want to go here. Let me try this real quick. I'm going to go to the free webinar section. Okay, first off, webinars page, powerop.com/webinars.asp. William, you know that is available, of course, but I'm just going to send it to everyone in the chat room. Okay, and 4 different categories here: tools, strategies, concepts, requested topics. Let's go to options, strategies, and this one's an okay one, but that's not the one I want you to focus on. This one is going to be related to Octavio's question. Okay, but I'm going to go back down. All the way down here, about 2 years ago. All right, there's 2 webinars I'm going to want you to look at. First one, 8 ways to manage a bull put credit spread, 9/19/2018. Okay, so not quite 2 years old yet. All right, so this is our preferred 8 ways to manage a bull put trigger points to know when to consider managing, the pros and cons of each adjustment, all shown on a current trade, okay? So you just saw very briefly, William, the criteria that I was showing for the bull put credit spread. And I had mentioned things such as the MACD and the 85% probability. Well, the first 15 minutes of this talks about the trigger points. So what am I going to use my trigger points? Well, look, if I see the MACD cross over to the negative, okay, from a positive, if the stock falls within 1% of my short put strike price, if the probability shifts, and you could use delta for that too, but if the probability shifts from where I wanted it to be to 85, let's say down to some number like below 70, then I'm probably now at a point where I'm very seriously considering exiting the position or adjusting it. On a day like yesterday, I got lucky because I had entered my positions a couple weeks ago. The run-up prior to Thursday's events got me deep enough out of the money that when it triggered yesterday, the MACDs went negative, but guess what? They all still stayed above 1% of my short put strike price. So I left it alone. They never hit that trigger with only 2 days to go. So I left them alone, hoping today we would have a recovery, and we did. So all 3 positions I had open expired worthless. Had that not been the case, and you'll see this in this webinar, but to keep the trading plan safe, to keep the trading plan accurate, okay, let me go to what's called the trade simulator tool. And I had mentioned that my average for the weekly bull puts is around 14.9%. And if a sudden decline happens, William, and I see my position hit a 50% loss, what does that mean for a credit spread? Well, let's say I got 50 cents on a 5-point spread. My true risk is 450. If the stock suddenly plummets and my debit to close that spread is 225, half of the maximum risk of 450, I'm probably just going to exit it. Why bother trying to roll the put down? You could lose more, and I can't allow that to happen. Here's why. So I target my loss at 50%. Let's say I start with $10,000. I'm going to allocate 33% to each trade. Of course, though, probability of loss is only 15%. Okay, so this is, I'm not going to get it. It's about 84. Usually the probability, the success rate's around 83, 84% over the years I've been trading. It's a couple great years. From 2016 and to middle of 2016, I started implementing this idea with the testing, but I was trading it as I was testing it and so forth, okay? So 14.9% average wins over the years on the winners. 84, 83% probably. I should have put 17 there, but yeah, it's about an 83, 84% success rate. And I do limit my losses to 50% of what's invested or the max risk, and you can see that benefits over time. Same success rate, same win rate on the winners, but I take 75% of the expected. Look what can happen, even being right 80% of the time. You cannot allow that to happen in the credit spreads. You can't allow that risk to get away from you. Sometimes I know it does. I've had a position over the years, I want to say it was 2018. It wasn't that February 5th through 9th crash. There was some stock I was in that was not related to earnings, not related to an early earnings warning announcement. I can't remember what happened. Something happened. It was 6% out of the money with 3 days or 4 days to go to expiration on my bull put credit spread. It opened 14% down at the open. I think the CEO of the company opened his mouth and said something on Twitter. It wasn't Papa John's. It was something like that. It wasn't Tesla. Long story short, it opened up below both strike prices with 2 days to go to expiration. I was at a 90% loss on the position. I didn't want to take it, but I had to. What's the point of trying to manage it? And that's the other thing. If you take a 60, 70, 80% loss, even if your bull put spreads at an 80% loss, in order to roll it down and out, you're going from a 1 week or 2 week out spread probably 4 months out in time with a strike difference that's 3 times where you started. So your margin is higher because you have to get back that $2. No 85% probability spread that's 2 weeks out in time. It's going to give you $2 of net credit unless you're maybe 20 points apart. Okay? That's just so you got to go 4 months out in time. And you've got to maybe increase the strike differences too. So sometimes it's better not to do it. But this tool here, this simulation tool, trade simulator tool here, is very fascinating because this helped guide me to what I needed for my targets, 15-ish%, and showed me that, yes, I have to control the risk on the spreads to 50% in order to get the success rate I want long term. Okay, it's just simulating random winners and losers. Even if I went up to, I think it was 65, oh, it was 70%. Yeah, 70 was bad. 65 is maybe still okay. Okay, allowing a 65% loss is maybe still okay with an 85, 84% success rate. But once you hit 70, now it's gone. You can't do that. You can't allow that to happen continuously. You'll clean out your portfolio. Okay, so it has to be controlled. Oh, and also what you'll find out here, I'm sorry, folks. So that's 8 ways to manage the bull put. Go to powerop.com/webinars.asp, William. Watch that one. That's how I prefer to manage it, and it discusses the trigger points. This one here from January 21st, 2019, Credit Spreads Beyond the Basics, Part 1. What this goes through is this goes through a look at the expectations, structure, criteria, and trading plans to help you be successful at spread trading. And this goes more in depth into that trade simulator tool and what I found worked and didn't work. And you know what didn't work? Looking for a higher return. Going for a 25 or 30% return with a 75% probability. All my testing showed that actually lost money over time. Different market conditions, 2016, 17, and 18 as well. That's what I saw, okay? It was fascinating to me. It was more like it was greater than 70. I'm sorry, 70 to 75% probabilities on spreads with about a 30 to 35% return. Lost money. Why? Because when you have those sudden little glitches like we saw February 5th through 8th of 2018, 5th through 9th of 2018, things like yesterday, you take the 80% loss because you're closer to the stock price. You're only 70% probability or 0.3 delta. So when this happens, you're taking the 70, 80% loss, and that's crushing it. Oh, by the way, this should only be done, when I'm talking about this, keep in mind, this is only done with 10 or 15% of my portfolio. You can not do this with 100% of your portfolio because eventually there will be that day. February 5th through 9th, I closed 3 positions for an average of 50% loss that were all out of the money the day before. And only 4 days to expiration, okay? If I left them open to expiration to the 9th, 3 days later, this happened on a Tuesday, I think, in 2018. I think it was a Tuesday when it was Monday morning, I think. Long story short, they all would have been 100% loss. And the 2 days, one of the positions the day after that, it went to an 86% loss if I hadn't closed at a 50% loss. The other one stayed at about a 50% loss, then immediately went to a 90% loss the next day. Okay, and so that shows you how quick you have to be with it. But I was only trading it with 15% of my portfolio, which means that even though I took 50% loss of what I had invested in those 3 bull put spreads on February 5th, my total portfolio was only down 7%. And on a side note, I also suggest doing something along the side, i.e. when the VIX is low, buying VIX calls to help hedge in case the unexpected event, which luckily I had during that time, so it completely paid for the losses I took on the bull put credit spreads, but that was an anomaly. It doesn't always work that way. It's used to hedge it, didn't expect it to pay for all of it and recover all the losses that I took. But you see what I'm saying? If I was trading that with 80% of my portfolio and that 50% drop happened, where am I? I've lost 40% of my entire portfolio. That's going to be hard to get back even with leverage spread positions as well. Okay, so those are the 2 I want you to focus on. First one, 8 ways to manage your bull put spreads. I just don't have the time to go through all of the 8 ways right now, William. And credit spreads beyond the basic amount. Jotted note down here too. We did a review on the 8 ways to manage the bull put credit spreads. I think it was only 20 to 22 minutes long. And I'm going to try to find that link for you on the YouTube, William. I don't think it's on here. Let me check requested topics. Oh, there it is. Review of trading plans for the strategy and management techniques. Okay, so that was from April 19th. So I'll send you the link, William, to that one, which is shorter. The full video that I have there, the 8 ways to manage bull puts, probably about an hour and 20 minutes long. This, I think, is only 20, 22 minutes long, as I mentioned. I'll get you the link from that from YouTube and email it to you this afternoon after the webinar. No, Dan said for the 10 to 15% of your portfolio is the risk portion. No, 10 to 15% of my portfolio is allocated to bear call spread. So let's say I've got a $50,000 account. I allocate 10% of that, which would be $5,000. Okay, I'm going to split that 3 to 4 ways, depending if I'm opening 3 or 4 bull put credit spreads tomorrow. So yes, I am at full risk on the bull put credit spreads, which is why I just mentioned earlier when we were talking about the bull puts that I have to cap that gain. I will close them at 50%, a 50% loss, which would only be 7% of my total portfolio. I am risking 10 to 15%. That is exposed, but I will also look to use some of those other hedges that we've talked about as well, okay, in that case.